All right, well, Joseph, I want to welcome you back to another market update video. Kind of as a backdrop, we just entered into Q3. We're looking right at Q2 earnings season. We haven't gotten any numbers yet, and markets are essentially at all-time highs. And so I guess let's first just start with what we're seeing on the Q2 earnings expectations, and then kind of the rest of 2024, what expectations are.
Yeah, sure. So companies will start reporting here soon for the second quarter. And right now, analysts are expecting about 10% year-over-year earnings growth. That's come down a bit from where we were at the beginning of the year. The expectation was for about 11.5%, but that's pretty normal action among the analyst community. What they tend to do is project bigger expectations, and then as the date actually gets closer and you get management guidance coming in and honestly just sandbagging expectations, you kind of see analysts draw in. Then typically you see an earnings beat once it actually happens, and we kind of continue to play this game. So nothing to really read into the fact that earnings expectations have come down. I would just say that 10% year over year, now that we're on the cusp of reporting, is really strong. We saw strong growth in Q1, and the expectation is for continued growth into 2025. Now, I will say, though, that for 2024, at least, a lot of that growth is being skewed toward the Magnificent Seven, whatever kind of acronym we want to use. In fact, you can actually distill down to a lot of the growth is coming just from NVIDIA. So it's no surprise that that's been really the top stock of the year, because the earnings have backed the results. So they continue to produce good earnings. Analysts continue to increase their expectations. And that's really driving the index as a whole now that NVIDIA is such a large component. So we're not seeing the breadth of earnings growth that we'd like to see, breadth meaning all stocks, all companies participating in that growth. But at the index level, it's still strong. And the phenomenon that's being projected for 2025 is that the names that have led, Mag 7, NVIDIA, whatever you want to call them, that growth is continuing, but at a decelerating pace. And analysts are expecting for the broader market to pick up and to actually produce better year-over-year earnings expectations than the leaders that we've seen over the last 12 months. So that would be a welcome sight. Again, we continue to get this top heaviness in the market where the top names are the largest percentage that they've ever been as a percent of the entire index, the S&P. But for right now, there doesn't appear to be kind of cracks in this forecast, and we're expecting to see another good earnings season.
Yeah, and to your point, we're not seeing any earnings growth within small cap names or other names in the S&P 500 per se. It's mostly just driven by that, and so a lot of people are looking at that and scratching their heads and making new all-time highs. But the earnings growth that we are seeing in those top names, essentially are propelling things forward and higher, and essentially almost making way for the other ones to grow into future valuations. So I guess with that, I want to shift gears to talk a little bit about the correlation or the relationship between stocks and bonds. I know that we have talked about similar things in the past, and a lot of our investment philosophy is really looking at that relationship, and then how we are essentially hedging or adding other diversifiers in the portfolio outside of just bonds. But I guess let's first just start by explaining what that relationship typically is, and then what it is in other periods of uncertainty or rising rates.
Yeah, sure. So the whole concept of the 60-40 portfolio, 60% equities, 40% fixed income, is based on the idea that bonds and stocks move in either non-correlated or negatively correlated fashion. So stocks go up, bonds go down, or vice versa. And then at the same time with bonds, you're paid a coupon payment, you're paid an interest payment. So if that relationship holds, then they're essentially a positive carry hedge. Hedge because they move opposite stocks, positive carry because they actually pay you interest payment, a coupon payment, in order to hold them. So kind of the holy grail of investing there. And that's why over the last 20 or 30 years, it's become kind of the norm to have this mix of stocks and bonds. 60-40 is kind of the benchmark for that. Well, if that relationship doesn't hold up, then you got to question, do we need to continue to manage money that way? And what we've seen over the last 3 years is that the correlation with stocks and bonds has actually gone positive. And we look back in trailing periods of time, like the 70s and 80s and into the 90s, the relationship was positive as well. In fact, over time, it's been more positive than it's been negative. So this idea, this negative correlation that the 60-40 is built on doesn't really hold up over long periods of time. It's just kind of our recent past. It's what we're used to here in the recent past. We think a lot of that's dictated by how inflation is perceived. Now, inflation in our country has thankfully come down somewhat over the last couple of years. It's still higher than we want it to be. But right now, the perception of inflation is not perceived as a good thing. Same as the 70s and the 80s. The idea of inflation was seen as obviously taking wealth creation away, and we wanted inflation to come down. Whereas the last 20 years, we've been in a very low inflationary environment to where we actually wanted to see more inflation in order to promote broader growth. So when that perception changes to where inflation is not a positive thing, it's not seen as constructive, where we are right now, the relationship between stocks and bonds, and I'm not saying this is the only thing that drives it, but we think it's a contributing factor to why the correlation between stocks and bonds have changed. So we say all this to say, and I'll throw in one anecdotal point to kind of show how this has happened. So if you look at the last 12 readings of core CPI. CPI is the inflation gauge that the government puts out each month. So the core inflation gauge, in the last 12 readings where it has either come in above or lower than expectations, stocks and bonds being long-term interest rates, have moved in the same fashion. So when inflation has come in hotter than expected, stocks have sold off, and bonds have sold off, meaning interest rates have gone up. And when it's come in below expectations, stocks have rallied and interest rates have come down, which means bonds have rallied. So again, not what you want if you're owning something as a hedge. So how does this translate to portfolio? So as you said, we're doing things differently in that we're not basing everything on a 60-40 relationship. Yes, a lot of our portfolios that we own do own bonds, but we do it in a lesser component than a traditional or a comparable portfolio, and we're able in that fashion to allocate to other asset classes, more equities, managed futures, commodities in some instances. So you ask me, well, how are you able to do that and still keep a risk profile that's comparable? And we do that by having hedges in the portfolio. So option-based strategies can create an explicit negative correlation in an otherwise correlated environment to where you can own more of a risk asset like equities and still have a downside protection in the event that markets enter a risk-on environment, which we haven't seen in a little bit of a while. But we think this is not something that's a now phenomenon. It's going to go back to what we've seen over the last 20 years. We think we're in an environment of sustained positive correlation there. And as such, we want to invest accordingly.
Yeah. And when you say, I just want to reiterate this point, it's like when you say positive correlation, that means that in your portfolio, you have essentially two assets that work in unison. And so if things are going up, and bonds are likely to not move as high as stocks are. So you're essentially choosing between stocks or bonds in that scenario. So you're seeing more and more investors kind of getting rid of bonds in their portfolios so that way they can own stocks that are seeing earnings growth, passing that inflationary cost off to consumers, where when you hold a bond, it doesn't necessarily do that. So that coupon payment is nice, maybe in the context of where inflation is, but if rates are continually rising or not moving, then you don't want to be owning that, and it's not acting as a hedge. So I think that trend is, we're kind of in a period right now where that trend has really taken hold over the last few years, and then now it's just kind of everybody's anticipating where interest rates are likely headed. But if we stay in this 3, 4, 5% area, you're not going to be wanting to hold bonds very long. So
Yeah, well
yeah.
said.
So I guess just kind of moving forward here on the with things I wanted to talk about with you, as we hear the news, new all-time highs. I mean, as let me just take a step back. In 2023, it was easy to watch markets go towards a all-time high target back in, December 2021. Like we have a target, we're grinding towards that. Once we break through that and we're kind of in uncharted territory, then the narrative changes like, oh, we're at all-time highs, so we need to be selling stocks, right? So I think I want you to give some context to that and why that's not necessarily the best way to view allocating to stocks or taking risk out of the portfolio.
Yeah, sure. So you're exactly right. With things at all-time highs, we're recording this on the 9th right now. We're at another all-time high today. Valuations are stretched. We've talked about that on this show before. You get a lot of people say, "Hey, this has been a good year. I'm gonna lock in my gains. I'll go buy a 5% T-bill, money market fund, and just let that be that." After all, if things are at all-time highs, there's the most risk you would expect, right? And we've looked back empirically at this, and that doesn't actually tend to be the case. In fact, when markets are at all-time highs versus when they're not, the next 6 months tends to be more positive than the not cases with less volatility. And you could say that for a number of reasons. You may have a supportive fiscal or monetary backdrop. You may have a supportive earnings backdrop. But one thing, just as kind of a matter of fact, if markets are at all-time highs, everyone sitting in equities has gains. No one's sitting on losses and kind of feels good about where their standing is. So whether you say it's an emotional thing or supported by the fundamentals, there is an empirical case to be made that all-time highs are not when you want to run from stocks. And if, like Eric said, when you sold once we eclipsed the 2021 high back late last year, you would have not enjoyed all of this additional upside that we've seen since the fall of 2023. So again, we think it's a case where bonds aren't where you want to be, both from a money supply and currency debasement types of argument. But even if you don't think that's happening so much, even from a fixed payment and a correlation perspective, we don't think bonds are where you want to be. So we think even at all-time highs, you want to keep owning equities and then just own diversifiers in a portfolio that are going to have that negative correlation. And that's what we're doing differently.
Okay. Yeah. Thank you for doing that. So I just want to round it out with a not political conversation about what's going on with the two presidential candidates. And as we come into the election, I know that this is going to be most likely an ongoing, evolving scenario, but I think that there's some key points on how the timing, the candidates is just, it's different this year, and there are clearer market reactions to those types of facts, I guess.
Yeah, so you can't ignore it. It's an election year. You're going to see it all over your TV and everywhere you go. I think what's important to keep in mind is that, again, we look to the past for some sort of guidance, and you look back over different presidential regimes, candidates, and parties, and you just don't get much differentiation in equity returns. So I think the first thing to think about is that it's not the end of the world if one or the other wins from the market's perspective. Now, your individual policies and what that might be is more informative, but what the market thinks is typically less concerned about that. And I would say potentially even more so this year. Everyone's talking about how this is such a it's all, I feel like everyone always uses superlatives anytime anything happens, and when typically it's not the case. But this year, I would say that there's even less cause for concern there, because we've actually seen the playbook from both of these candidates before. They've both been president in the past, and Republican or Democrat, both were very supportive from a spending standpoint. And you could argue that might have some negative long-term implications if we continue to run deficits. But the market likes that, especially in the short term. And even President Trump, as a Republican, ran historically large deficits that haven't been quite as large as President Biden, but nonetheless quite large. So I think the market, less uncertainty because it's seen both these precedents, less uncertainty because it knows that we're probably going to continue spending money. And if you look back historically, the market doesn't tend to realize or recognize kind of the election and the volatility that can come with that until after Labor Day. Now, a little of that you could say is pulled forward because the debate in late June, a couple weeks ago, was the earliest we've ever had a debate in a presidential cycle. And because of the outcome of that debate and some of the conversations that ensued from there, you could say that pulled forward some of that volatility, but markets really took that in stride. I think the only thing you can say maybe with certainty in terms of how markets is that there are different baskets of stocks that should perform differently if one candidate over the other wins. Obviously President Trump is more defense oriented. President Biden is more environmental and alternative types of energy oriented. You can get more into their policies. There are buckets that are going to perform differently depending which candidate wins. But I would argue that the market as a whole, if you're indexing, which is a lot of what we're doing here, we're choosing to win more at the allocation level, as we discussed, as opposed to the individual stock level. If you're doing that, we really don't think it makes a big difference which candidate ends up prevailing in November.
Yeah, that's what we often talk about as well, is that, it doesn't matter Democrat, Republican, they all level out over time. It's just there's typically a period of when markets start to price in some uncertainty. But to your point, we're looking now, at such an early first debate that, and the things surrounding that, it's almost like the market has made its decision that doesn't necessarily care one way or the other. Now, the only thing is, Biden did say as of yesterday that he's not dropping out of the race and he's staying in. So as of now, they'll likely be the two candidates, but there is a potential that maybe some more uncertainty with if he isn't the candidate, somebody else replacing him, those policies, that uncertainty could be priced in. But that's as of now far-fetched and yet to be seen. But we will, like I said, this is going to be an evolving thing. But I think it's just important to reiterate the fact that regardless of who the presidency or president is, the markets generally do well post-election, and they essentially level out in return expectations as well.
Yeah, I guess the only other thing I'll add about the election real quick is probably the biggest thing we'd have our eye on is anecdotally or tangentially related to the markets, but it would be taxes. In 2025, you get a sunsetting of the Tax Cuts and Jobs Act that Trump passed back in 2017, and you've got different provisions within that are going to be up. If Trump gets reelected, one would assume that all that's going to get extended. If it is Biden or a different Democratic candidate, there could be some reshuffling there, but that also takes Congress as well. So it's going to depend, as it usually does. It's probably more informative what's happening at the congressional level than it is even at the presidential level. So I think that's going to dictate a lot of what these tax consequences look like, and that will have an impact on markets, especially what happens with the corporate tax rate. But it's going to be probably more influential at the individual level and what's decided there. So Eric's right. We certainly aren't positioned differently because of our prediction of what may happen. We think that sort of thing is a losing type of proposition. We'd rather win at the allocation level and keep doing it that way.
All right. Well, Joseph, thank you again for joining us for another market update video. And yeah, for all your time and expertise, we thank you very much.
Yeah, my pleasure.